Let's so welcome in Rahul Singh, Chief Investment Officer, Equities at Tata Mutual Fund, who's joining in to take some questions. Rahul, good to have you with us here as always. Thank you very much for your time. Stay on track, stay invested, stay fully invested. Rahul, is that the advice? Should one start to think about mid caps versus small caps and large caps versus mid caps and that kind of thing, or it's okay out there, even mid caps and small caps?
Yeah, hi, good morning. I think stay on track is the right message, whatever was your asset allocation between equity, debt, or large cap, mid cap, small cap, because each investor is different. But stay on track probably is the right message, because what we are seeing is continuation of what we have seen in the last 1.5 years, really, that the Indian economy is seeing a broader recovery than what we have seen earlier, even though we are not, nowhere near the heady days of 2006 to 8 of 8-9% GDP growth rate. I think 6.5% GDP growth rate with a broad-based growth is definitely something which is leading to a broader market movement and not just large caps. So therefore, we are constructive on small and mid also as a segment, because that's where most of the resurgence, or let's say the revival, seems to be happening, given that last decade was really not something to write home about in terms of the investment cycle. And that is the one engine which was missing from the economy, and that is the engine which has restarted in a small way. So therefore, I think the idea is to stay on track, and I think whatever we are seeing in the market is a healthy consolidation phase, I would think.
Okay, a healthy consolidation phase, and the idea is to stay on track. Rahul, thanks a lot for joining in and speaking to CNBC TV 18. You know, the one space that has made a big comeback this year is capital goods. And I'm talking specifically about L&T. I mean, this year, if you map it, right, L&T is up almost 30%. And we do know that there is a bit of a revival in the capex cycle. These long cycle diversified EPC companies have started to do very well. Is there more to go? Do you think this is just the start of the upcycle here?
Well, I can't comment on individual stock, but overall, as I mentioned, I think the investment cycle has three legs: government, private sector, and households. Government, obviously, last two budgets, you've seen that they have used more of the fiscal deficit for capex rather than opex. You look at the private sector, the capex revival is definitely real. Some of it is because of competition like cement, etc. Some of it is because of China Plus One. Some of it is because of energy transition. And also remember that the balance sheets are quite clean. Companies are generating cash flows. Bank balance sheets are the cleanest they have been in the last 10-12 years. So overall, it's a perfect situation for investment cycle to start reviving. And the last leg, which is the individual, the household, you've also seen a revival in the real estate. So basically all three segments of the capex cycle or the investment cycle are doing well. So I think the chances that this sustains are pretty good, because the drivers are not just one. For example, in 2006-8, it was just infrastructure. Today, it is infrastructure, it is energy transition, it is China Plus One, and real estate. So the chances that even if one of the drivers slows down or falters, you would have some of the other drivers leading to a sustained investment cycle performance. And as I mentioned, we may not see the heady days of 2006-8 when the investment cycle or the GFCF growth was 15-16%. But even a high single digit is good enough to generate growth for the companies, especially in small and mid.
Got that. By the way, the market slipped into negative. So the bulls are not going to like this on a day when you have so much of green on global screens and you have Asia up between 1.5% to 2.5%. We are not finding a follow through, at least on the headline indices. A little tinge of red on the Nifty. The low, just to keep it in mind, Friday's low was 19,229, roughly 19,230. We're far from that, but let's see. Bulls are finding it difficult to retain the momentum, already flat for the timing. Even the mid-cap market has cooled off from the day's high. Rahul, hi, good morning. I guess purely from a Nifty perspective, while, as you say, a lot of the macros probably are in place, But purely from the Nifty perspective, the last 1 month has been interesting because FPI flows have reduced compared to the deluge that we were getting in April, May, June. Maybe the data is skewed because of all the block trades that are happening, but the net number is lower compared to the highs of earlier this year. And B, there seems to be lack of leadership. IT stocks, I mean, not quite the torchbearers. Banks have been underperforming as well. What do you think is going on, and what can what can be expected, say, over the next 6-8 months as we get into the interim budget and then eventually to the general election?
Yeah, so I think we also have to remember that the interest rate narrative globally has changed a little bit. We were looking at 3.5, 3.6% US 10-year, and now it's 4.2, 4.3. So clearly there is a 50 bips movement there, and the narrative on the inflation is kind of become a little bit more hawkish than what was at the margin. It's become more hawkish than what it was, say, 1 or 2 months back. So clearly that is getting reflected in the consolidation phase, which I mentioned in the markets, and I think it's healthy. What we don't want is a runaway market because the macros for India are good. The broad-based recovery is in the investment cycle, and the fact that India is growing faster than most other emerging markets means that what we don't want is a runaway market or a bubble. So this is something which has come at the right time. I would think that the interest rate movement or the confusion around which way the interest rates are going to go, rather than everyone assuming that there will be a rate cut in 3 months, 6 months, maybe the market is now probably 50-50 that there is going to be a rate cut or not this calendar year. So I think that's a good position to be, because it allows India to continue to grow at a steady pace, be in a situation which is a sweet spot, and continue to sustain this valuation premium which we are at today. And as I mentioned, I think as far as leadership is concerned, I won't really delve too much into it, because when the economy is becoming slightly broad-based, there is unlikely to be a clear leadership sector-wise. And that's fine. I don't think that is necessarily a limiting factor for how the markets might shape up over the next 6 to 12 months.
Okay, just before we let you go, Rahul, then, just one question on what the big risk factor is now for the markets. Of course, we're heading into an election year as well. There is all of this talk about perhaps the US entering into a recession. Are any of these factors something that could derail the market in the near future, or do you think this uptrend is intact in the medium term?
I think the risk factors have to be commodity prices and crude as far as India is concerned. These are always risk factors, but right now there is a little bit of complacency there. I don't see much changing there though, but there is definitely complacency there. So that is something which I would worry about, especially if China comes out with a stimulus, again something which we don't know about, but that revives the commodity prices and crude prices. Then we are potentially looking at some of the macro factors which is leading to a sweet spot, which I mentioned earlier, kind of getting diluted for India. And of course the general elections remain difficult to call so early. That's something which we will have to assess as we come closer to that.
Okay, we'll leave it at that, Rahul. Thanks a lot for joining in. Appreciate your thoughts.